Hello and welcome back, everyone. Both our cash secured put and our covered call expired worthless, so we need to go ahead and update the web application and start looking for some new positions for this upcoming week. So let's get right to it. All right, so here we are on the website myatmm.com, and we're looking at the Marvell position, the cost basis screen, and let's go ahead and just expand the puts and the calls here. As you can see, the strike price is $43.50 for this put, and it closed at 44.04 this past Friday. So that one expired worthless, out of the money. So we can go ahead and close that, or really take it off the board. And the covered call, the three contracts we had a strike price of 45, and again that was under that, so that was expiring worthless as well. So we can take that off the board too. So anyway, so now we're free and clear all this. We still own the 300 shares. Our cost basis is 45 still, so we would be looking for another covered call around 45, and do another cash secured put at 44, it looks like. So let's go over to Ameritrade and do that right now. All right, so here we are in Ameritrade's Thinkorswim paper trading account. And as you can see, we still have Marvell, and we still own those 300 shares in this paper trading account. And there's no more options because they expired worthless, so they expired and fell off the screen. All right, so, and yeah, 45 right here, same as our cost basis over in the web application. So let's go to the Analyze tab, and we'll be looking, we're making sure it's setting on Marvell, which it is. Let's go ahead and collapse all these. And so we're looking for options expiring this Friday, which is March 10th, so that's 5 days from now. All right, and first things first, let's go ahead and do the cash secured put, because that's usually always the easiest one, because we generally do it always at the money. So that will be this one right here, the 44, because the last trading price is 44.04. So we will left click on this bid thing, and as you notice, hovering over the mouse, the little tooltip shows up called sell, and that's what we're looking to do. We're looking to sell a cash secured put. So we left click on that, and the spread, the difference between the bid and the ask, it looks like is 4 cents. So midway is 2 pennies. So we should be able to collect 2 pennies more than the bid, and we do just want to do one contract. So we want to right click, click confirm and send, and that should bring in around $105, 106 minus the commission. So let's go ahead and click send to queue that order for tomorrow morning. All right, so that's queued. Now we're looking to do a covered call for this Friday at 45 is our cost basis. Okay, so 45, and the bid ask is 65 on that. Again, hover over the bid column over the 65 cents and left click on that to bring up a covered call order. I have it defaulting to one contract, but we own, remember we own 300 shares of this, so we can do 3 covered call contracts at 45. The spread 65 to 69, that's again 4 cents is the spread, so we should be able to collect 2 more pennies than that. All right, so we upped it to 67. Now we're going to right click again, confirm and send, and this one should bring in around $201 minus commissions, which is about, I think it's 65 cents per contract. So we should bring in still around $200, $199.05. All right, let's go ahead and click send. And now that is queued up as well. So now we have the covered calls queued up and the cash secured put queued up and ready to see if they'll execute tomorrow morning when the market opens. And a question that I was asked recently, and I've been meaning to cover in another video, but it has to do with the cash secured put side, because the more and more we sell cash secured puts, the more and more, if they get assigned to us, the more and more capital we keep dumping into this stock or putting into this stock. And if you have the capital available, then that's fine. You can just keep on doing that. It'll just continue dollar cost averaging, and it'll work. It'll work good. But if you are limited on capital, or you're just not wanting to put any more capital into this specific stock, then what you would do is you can still play both sides, still do the covered call side and still do the cash secured put side. However, if you don't want to get assigned, like if this becomes in the money, then you risk assignment, right? Well, if you don't want to continually put more and more money on it, what you need to do is you need to start rolling these cash secured puts before expiration. And depending on how deep in the money they are, you may need to roll them several days before expiration. A good rule of thumb that I use normally is I look at the extrinsic value that's still left in this option. And if it's really low, like right now, you can see there is $1.06 of extrinsic value. Pretty much the entire premium is extrinsic value, which makes sense because it's not in the money. In the money would have intrinsic value as well, but out of the money always is just extrinsic value. So when this number starts getting lower, I usually use 0.1 or lower, and generally I kind of play it off of how deep in the money it is and how close it is to expiration. So generally I will look around 3 days prior to expiration. And I do monitor the extrinsic value the entire time. So if it has a really, really low extrinsic value, even 5 days before expiration, even maybe 7 days before expiration, I'll go ahead and roll it just to minimize the risk of early assignment. And basically just keep on rolling it indefinitely as long as you're collecting a premium. I still only try and roll it 1 or 2 weeks out. Sometimes you got to roll it up to 30 days out to collect a smaller premium. And the further and further in the money it does get, you may have to start rolling it further out, but also start trying to roll it down too, to follow it down, so you don't get too far away from it. Because at some point it may get to the point, I mean, if it's dropping, if it's tanking like a rock, you may have to definitely roll it because there may not be that strike available further out in time. The further you go out, the fewer strikes that are available to actually sell options on. So anyway, that's one way to stop putting capital into a stock, by just continually rolling it. And I actually do the same thing with the covered call side. I haven't been doing it in this demo account, but generally, if these become in the money, but I can roll it and still collect as much premium, or enough premium to be worthwhile, I'll just keep on rolling the thing, collecting more premium. Because basically what you're doing is you're reutilizing the capital that you already have invested. You're just continually reusing that same capital over and over and over again, just collecting more and more and more premium off of it. And it almost doesn't even matter. I mean, the strike price and the price of the stock basically just varies how much premium you can collect on both sides. But you're still reusing the same capital and not risking any more capital by doing that. But in any case, we will wait to see what happens tomorrow, adjust the positions if necessary to get them to execute, and we will review that tomorrow. I want to thank you for watching. Like and subscribe if you haven't already, and go out today to get your account at myatmm.com. Thanks, and I will talk to you in the next one.